There's really nothing more important to a business. Cash flow management is number one.
What are the signs of a healthy cash flow in a company?
The biggest misconception in this market is people thinking that you ask someone for money because you don't have money yourself. You have to cut the bad clients.
How does that help the entrepreneur?
It's very much about getting the most out of the money that they have. There are so many big impacts of having a shorter cash conversion cycle. We're working on aligning ourselves with the leadership. The most important thing that any founder could do is come work with HFA.
Welcome back to Rising Sharjah, where we explore innovative solutions driving entrepreneurial success. Did you know that 82% of small businesses fail due to cash flow problems? Today, we're excited to have Malachi Halliday, CEO of Halliday Forfeiting Services, to discuss the pivotal role of cash flow in sustaining and expanding businesses. Thank you so much for joining us today, Malachi. Let's start off with our first question. As you know, our audiences are people who are just new into business or starting off. Could you explain cash flow management to them in a very simple and easy way?
Absolutely. So simplifying it as much as possible. Cash flow management is all about handling what comes in and what goes out and planning in anticipation of what's going to come. There's really nothing more important to a business, not providing value to customers. Cash flow management is number one. I think the clearest examples of that are when you have a company like Credit Suisse, which was profitable for over 150 years, adding great value for clients. And just last year, they had to get bought out because they didn't manage their cash flow. You have other companies like Amazon. They were delivering value, but they weren't profitable for 10 years. But they managed their cash flow, and here they are as one of the largest companies in the world today. It's the cash flow management that you see again and again being the most important factor of any businesses.
So what would you say are the indicators or signs of a healthy cash flow in a company?
So we fund a lot of companies across the UAE, and we divide them into four broad categories. The first category are companies that have so much free cash flow that they're growing rapidly, they're paying out dividends to their shareholders, and there's so much cash that they can't allocate it efficiently in their business, so they're drawing it out of it. Then you have the next category. These businesses, they have a surplus of cash flow, and they're allocating that surplus towards growth activities. This could be marketing, it could be scaling up. So they're in a growth phase and they have surplus cash. They have a full rainy day fund and have great momentum. The bucket after that, the categorization, would be all of those businesses that aren't saving any money. They're covering their expenses, but they have no capital left over to invest in growth. So they can't do new marketing initiatives. They can't hire more staff, etc. These companies, they're kind of just making it. And then the last category would be those businesses which are really struggling to cover their expenses. Maybe they're stretching out their payments to their suppliers. Maybe they're asking their staff if they can pay them a bit later this month. Maybe they're having to invest their own capital as the shareholders. So these are the four different categories that we put every company in when they come to us for funding.
Taking that thought forward, what would you say are the common mistakes that businesses make in the early stages when it comes to cash flow management?
It really depends on which categorization they fall into. One struggle we see new founders face is balancing the timing of their revenue with what they expect, with what actually happens. And I'm sure this is something we'll talk about more today through how the economy works here. But for a lot of founders, especially in the B2B space, after they do the job, they don't necessarily get paid straight away. Right. It can be 30 days, 60 days, 90 days. Now, the impact of that on their cash flow when they're growing is they can have great sales. They can be hiring well, building great product. But the revenue from a sale might not come in until 90 days after a job's done. So they have to cover 90 days of working capital. That's 90 days or 3 months of additional staff salaries, rent, inventory into the product or service that they're offering. And the next aspect of that, which compounds, is the timing is one thing, but then the size is the next. Because let's say this business is going really well. They're offering good value to clients. And even job by job, they're profitable. Let's say they have a 20% margin per job. But if they're not getting their revenue from that first job until 3 months later, then they have to pay for the second job and the third job. And the second job and third job, they're having to pay more and more and more, even before they have this smaller revenue that they've got.
Yeah.
And as their business grows, that gap between the size of their growing revenue and which is lagging from the size of their growing direct cost of goods sold. It gets larger and larger, and it's hard for a lot of new founders in this region to really stay on top of that.
So what do you suggest they should do to combat this gap that they're essentially creating by value of their work?
Absolutely. There's a few things that we see founders do that they should avoid, and a few things that we don't see much, which we wish they'd do more of. The first one that we see founders do again and again, which breaks our heart, is they overbuild capacity. Now, what do I mean by that? Every business is different, but there are inputs into their product or service which they have to get ready before they deliver the good or service. For example, sitting at this table, maybe their business is selling tables. So they might be buying the wood and then the paint and then put it together with some labor. They might be tempted, if they're buying from their supplier, to buy a year's worth of wood for the table because they can get a discount. However, having that much cash tied up in the inventory for additional capacity in case that their revenue and their job orders soar, that ties up their capital from other things which they might need to cover in the short term. So that's the big thing of overbuilding capacity. The most common one is getting an office that's too large for what they need and hiring a team across all industries, hiring a team which is more than what they need and not taking advantage of fractionalized staff offerings and a lot of services these days since the wave of AI technologies have come in to automate any mundane or repetitive tasks. These are things which we see founders not really taking advantage of as much as they could.
Speaking of challenges that companies face with cash flow management, are there any challenges that you could pinpoint which are unique to businesses in Sharjah?
As far as the business environment in Sharjah, there aren't any additional challenges that founders have to watch out for because there's so much support in the Emirate of Sharjah. There are challenges that are typical to this region, which I can share, both in the Northern Emirates, but the GCC is a broader economic region. The first major challenge is something that I touched on before about the timing of collection of payments. So the average for B2B businesses, specifically, the average collection time for payments is over 100 days. So it's actually 107 days at the start of this year. The average invoicing time is 67 days. But even after the invoice it comes due, there's another over a month for these companies to actually collect. Now, that does a few things. First of all, that makes planning cash flow incredibly difficult and even more important because it exacerbates the smallest challenges in a business. Secondly, aside from the planning, is the actual implementation of their strategies and their growth plans. If these companies, again, are tied up with their working capital in the business, 1 month, 2 months, over 3 months, then the natural instinct would be, well, they should go to look at what sort of facilities are available to them. However, businesses in the Northern Emirates, especially, but micro enterprise in a more broad sense across the UAE really struggle to access working capital from the banks. There's a myriad of reasons, or there's a range of reasons why this is the case for small businesses here. But when these micro enterprises are effectively financing their corporate clients by paying them 3 months after the job is done, and they're not able to access working capital from the banks, these same small businesses, which would be very well funded and have access to liquidity elsewhere, they don't have that same access to liquidity, which limits their growth. The really big challenge that compounds that even further, unfortunately, is about 11% of invoices in this country, so it's not Sharjah specific, but in this country typically aren't paid. So when these micro enterprises and these amazing founders start their business and they win these clients and they do the jobs, and then 1 in 10 of these clients don't pay, it does two things. First of all, the founder doesn't know when someone's not going to pay. They always think it's a week away, it's a month away, maybe it's 3 months away, which affects their growth plans. The second thing is when they eventually write it off, it affects their books, it affects their morale, it affects their liquidity ratios, and it messes up their planning, it messes up their business. And if you're operating on fine margins, losing just straight up 10% of your revenue off the top when you're projecting and getting that, it can be catastrophic for a business.
Also coupled with, the economy in UAE is very seasonal and prone to like a high tourist season, high business season. There's also a lot of fluctuations in terms of, you seem to have recessions every few years here. How does that affect the cash flow management of small companies?
It's incredibly challenging for small businesses across the UAE, again, not just in Sharjah, to manage. First of all, you mentioned the tourism and people coming in and going out, also the academic calendar as well. The summer slump is incredibly real and incredibly challenging for a lot of the founders here. So what we see is, of course, the sales slump during summer, but also at the tail end of summer, a lot of the obligors, the large corporates that have been buying the goods or service, and even at the B2C end for large private clients, at the end of summer, they're extending payment terms more and more. And it happens every year and it's really tough. So founders and business owners, they have less revenue during summer, and the revenue that they do generate, they're getting paid later.
Yeah.
So the actual working capital in their business gets really stretched at the end of summer. So that's something that happens every year, which businesses can plan for. The other one, which you alluded to, is every few years, there's some sort of economic contraction across the UAE and regionally as well. And this is something very hard to plan for, because a lot of the economic factors that affect business in the UAE are external to the market here. Despite the incredible leadership and management of the economy here and all of the incentives that are put in place for small business, if the oil price collapses, that has a real impact on business. The currency gets a lot stronger. That affects all of the tourists that are coming, of course, because they can't afford to come here. They'll choose somewhere else. These factors have nothing to do with what founders are offering to their clients or how they manage their cash flow. So what we always recommend to our portfolio companies that we're funding is, regardless of their stage, keeping working capital in a rainy day fund, we call it, in our business, as well as ensuring that in advance they have facilities available if something were to happen with their business.
Like saving for a rainy day.
Saving for a rainy day.
Yeah. Can you tell me how important is access to real-time financial data? How important is it for new businesses in order to plan their cash flow?
We offer a fractional CFO service. We're all about data. We're all about finance. And for a lot of founders that are listening today, access to real-time financial data, not important. Not important at all. Founders only have so much time and mental energy to allocate to their priorities. If a business is in either of the two buckets, which I described earlier today, where either the first one I mentioned was where they have so much free cash flow, they're paying it out in dividends, or at the other end of the spectrum, where they are struggling to pay their bills, in these two, there are other priorities that they should have with their business. So it's a really interesting one, because if the business is generating so much surplus cash flow that it's paying out in dividends, and there isn't an efficient use of funds within the business, real-time access to financial data, it's not important. Priorities should be on identifying new growth opportunities or seeing what else they can do with that capital outside the business. If a business is at the other end of the spectrum and they're struggling to pay their suppliers, they're struggling to stay above water, as we say, these businesses, access to real-time data isn't solving their structural problems in the business. For them, maybe zero-based accounting and just justifying every single expense from that moment would be something they should prioritize over analyzing their real-time financial data. That's juxtaposed with the two central buckets that I mentioned before, the two categories which we're funding. The companies which they're not really growing, they don't have spare capacity, spare funds to support growth activities. They're chugging along, they're doing okay. These businesses, there's a lot of room usually for increasing efficiency. And in that increasing efficiency, they can often find ways to then fund their growth. In that case, of course, real-time data is really helpful. The other aspect is when a business is growing rapidly, they are funding their sales, but they're making a lot of commitments and growing commitments. So commitments to clients, commitments to suppliers, to staff. Then these companies, they need really good data so that they're making the best decisions possible, because at this stage of business, You can get away with small problems in a small business, but those small problems only amplify as a business scales. So it's really those two central categories.
Makes a lot of sense, which brings me to HFS, which is the company that you head and manage. Could you tell our audiences more about what is it that HFS does and how does this help new entrepreneurs?
Absolutely. So HFS, we provide funding, first and foremost, to B2B founders across the UAE. Combined with this funding, we also provide fractional CFO.
Okay.
And we combine the funding and the fractional CFO to significantly accelerate the revenue of businesses. So we're not just giving money and we're not just giving advice. We're really focused on shortening cash conversion cycles, which is kind of an accounting thing. But the impact of shortening the cash conversion cycle for these founders and handling all of the CFO related issues frees up their time to focus on sales, frees up their time to focus on delivering the job and improving their product, and also provides the funding so that when they win these sales and they can deliver, they can fund the job and get it done. So that's our role in the companies that we support.
And how does invoice discounting work?
Right. So it's a great question. It's something that's not broadly used in the UAE. So let's say you have a business that has 80 dirhams of working capital. We'll start small. And with that 80 dirhams, you can do a job that you'll make 100 dirhams from. So it costs you 80 dirhams to do the job and you'll make 100 dirhams. Now, as I mentioned before, when you do jobs in the UAE, you often don't get paid straight away. Yeah. So if you get paid, after 2 months, or we call it cash conversion cycle, from when you have to invest to when you get the money back. Right. Let's say that takes 3 months. So if you only have a limited amount of working capital, you only have the 80 dirhams, you invest that 80 dirhams, you've done the job, and then you wait another 2 months, because if it takes you a month to do the job, but you wait 3 months in total to get that money back before you start the next job. So then you can use that money 4 times in a year.
Right.
So if you're doing a job 4 times in a year with your limited working capital, then you make that 20 4 times in a year. 4 times 20 is 80.
80.
Let's say you use something like invoice discounting, any form of revenue acceleration, shortening your cash conversion cycle. So rather than taking 3 months to do the job, you take 1 month to do the job and you get paid and you get the cash back in your account from invoice discounting. Okay. Still you make 20, or maybe you make 15, but we'll keep the number simple for now for 20. Same amount, 20, but you do 12 jobs in a year. Suddenly you're making 12 times 20 is 240.
Right.
So you have 240 of profit instead of the 80 of profit.
Right.
So with that 240, you can cover more overheads, you can fund more business development, your profitability is higher. So if you're raising funds from investors, or if you're going to a bank or wherever it may be, you don't have to raise as much and have as much dilution. There are so many big impacts of having a shorter cash conversion cycle, which is fundamentally what invoice discounting is solving.
Yeah, I think you've made that very simple for our audiences, owing to the fact that even I, who don't come from a finance background, perfectly understood it and can probably explain it to someone in the future. But could you explain to me now how HFS uses a fractional CFO service and how does that help the entrepreneur?
Absolutely. So what we've found, we've been funding companies for years. I've been here since 2010. A lot of founders, it's one thing to give them the money so that they can do those jobs and do those 12 jobs in a year. But a lot of founders, they don't have time to study invoice discounting or cash flow or capital efficiency, all this stuff. So they will often use the money to pay whatever bills they have, and they'll maybe invest it in an office, something I mentioned earlier, or other non-essential capacity building expenses, things that don't directly contribute to their cost of goods sold and increasing their revenue in the short term. So to avoid this and help ensure the best use of the funds that we give companies, we provide that fractional CFO giving advice on where to spend, how to spend it, and how much it should cost them when they spend it. So it's very much about getting the most out of the money that they have, the money that we give them, as well as the money they already have. And it's one thing, if I have one frustration with the market, is there are so many people, advisors, consultants that will, they'll say something to a company, some sort of generic advice, which they've given to 100 other companies, but they don't have what we call skin in the game. If they haven't invested something from their side, that affects the value and the weight of the advice they're giving.
True.
But we're giving these companies money.
Right.
We have skin in the game. We're sitting right by them on this journey with them. And our biggest goal is sustainable growth of their business. Even compared with other funding solutions like VCs, where they've got things like the power law and they're wanting that 1 in 20 to be super successful. We're not following the power law. We want every company we fund to be successful. So all of the advice that we give and the insights that we share is through our fractional CFO. That's to ensure safe, sustainable growth for their business.
So what would you say are the steps for a company to engage with HFS? And what are the criteria that you keep in mind before deciding to engage with a company?
Well, I love this question, of course. Companies can reach out to us over LinkedIn. So I have a LinkedIn profile. We have a company page. We also have a website. So any of these channels which are convenient for founders, they can reach out to us. We also have a promotion with SPC, the Free Zone, giving benefits, additional complimentary CFO services and additional funding to SPC customers. So if any can reach out via SPC, or even if they reach out to us directly and mention this podcast, then of course we'll be giving them benefits of the promotion. So one of the things that's really important for us when customers are thinking of reaching out, we love everyone, like everyone in the B2B space in the UAE, we want to support and add value. So we do provide a lot of content online, just complimentary for the founder community, because we're a company of founders, we know what it's like, and it's really hard to access this information otherwise. For the companies that we want to fund, we do have to be a little selective. So we're looking for companies that are generating revenue of between 50 to 500,000 dirhams per month.
Okay.
We're also looking for businesses that are B2B, ideally businesses that have a cash conversion cycle of at least a few months, especially businesses which are getting paid 30 to 90 days after they've done the job for their corporate clients.
Got it.
And if I had all of my wish list, then I would, of course, love companies that are selling a good or service, which is kind of niche. And I'll give an example of one of our portfolio and why it's important. So one of the companies in our portfolio, they make and sell aquariums.
Okay.
And on the face of it, that sounds very simple and it sounds very project-based. You do the sale, you deliver, and then you move on. But these aquariums, they're 1 million, 2 million, 3 million dirham aquariums. So they're very specific demographic, very niche. And the service provider that we're funding, they're hard to replace. After they make the sale, they still have an ongoing role with the client. So you would think, oh, it's just installing a fish tank, the job's done, halas, move on. But if they don't maintain the marine environment that they've built, all of the very expensive fish and coral, all of that, it doesn't continue living. It doesn't look very pretty after a while.
Right.
The impact of that is, firstly, they're more likely to get paid after they've delivered the job. So the credit risk immediately reduces. Also, because it's so niche and specific, they can command a greater premium. So they have higher profit margins. They're also more likely to get paid. And this is one of the many things that we look for and advise our portfolio companies to really focus as much as possible on being irreplaceable and important to your clients. And we do a lot of content and a lot of advice on how to get paid, how to improve their collection process and this sort of thing.
And how quickly would you say, or would a company that partners with HFS start seeing an improvement in their cash flow management?
We typically aim for doubling their revenue within 12 months.
Okay.
So that's our target that we set internally. Okay. As far as the first impact they see, with the fractional CFO, we immediately come in and within a month, when they've enacted some of our suggestions, they see some increases in their capital efficiency. That either means reducing their expenses with their additional capital, or they get more impact out of the capital that they're using. That's from the fractional CFO side. From the funding, which of course we also do at the beginning, they see the increased revenue from that and the increased jobs that they can take on, one cash conversion cycle out. So as soon as they see the first revenue come in from that client that they've been selling to, that's when they see the impact and their revenues really skyrocket.
And would you say there are any specific sectors of businesses in Sharjah that could really use your service and benefit from it?
We see the biggest impact in businesses that are entirely domestic, entirely within the UAE, businesses that have profit margins of say 15% and more per job. Businesses, if I can come back to earlier in the podcast, businesses that are either not so much growing right now, but have the potential to grow. Maybe they're just limited in their working capital they have available to them. And the other category where they're going through a growth phase and they don't have the working capital to keep up with their increasing sales. And if I can just mention something on that point, the biggest misconception that we see in this market is people thinking that, oh, you ask someone for money because you don't have money yourself, because business isn't going well. We don't even fund businesses which are losing money. We don't fund businesses which are struggling to make their payments. We only fund businesses which are growing quickly because they're the exciting businesses. They're the businesses where working capital can make the most impact. So any company that's in our portfolio, they're growing companies. They're a niche product. They're high value product. They're the exciting businesses that we love to support.
Could you share a success story of a business that was born out of the UAE and how they benefited from HFS?
So there was a company that was selling to ADNOC.
Okay.
And ADNOC is a huge group based out of Abu Dhabi. Anyone in the UAE knows ADNOC. So they were going through an incredible growth inflection point. They just come out of COVID. And this company, especially everyone knows following COVID, your Atleti had credit bureau report was not good. Most companies had bounce checks, which meant their credit score was terrible and no bank was funding them. This was for all companies. Now this company came to us and they said, look, we've just hit the jackpot. We've won these incredible orders with ADNOC, but we have no way to fund them. We're doing an amazing thing. We're taking used oil from restaurants like McDonald's, which would otherwise end up as toxic waste in the dump. We're taking that, we're processing it and selling it as green fuel, which I loved. I thought was amazing. So we proceeded to fund them. And we ended up giving them over 5 months, about 3.5 million dirhams. And their revenues absolutely skyrocketed to the extent, as of last year, they were looking at IPOing on a secondary exchange. So financially, they did very well. And their environmental impact as well. As stated on their website, as of late last year, they've saved over 50 million cubic meters of CO2 emissions. Kilograms of CO2 emissions. A huge environmental impact, which is exactly the businesses which we got into this to support, is the environmental impact, the social impact. So they've scaled incredibly. They started with our support and we're immensely proud of it.
It's amazing to know how much value you bring to small entrepreneurs and you literally help companies turn around like a bad time into, multi-million-dollar sales just within a few months. So for entrepreneurs listening today, if they want to get, tie up with HFS or get funded by HFS, what is the process and how does it work?
What's really important for these founders to understand is we're not taking equity. We're not like a angel equity investor or a VC. So that means we're not on their trade license. We're not diluting their profits for the rest of their business lifetime. We're not trying to commandeer or control the direction of their business. We're also not a bank. We're not giving a loan. So it's not debt on a balance sheet. We're more, we're invoice discounting, of course. But to think of it from a founder's perspective, we're providing the cash against invoices which they've generated, and we're providing the fractional CFO. And what we get in return are fees each month as a percentage of how much we've given them. So for example, if they have 200,000 dirhams of revenue that month, then we'll have given them 200,000, 300,000 dirhams, something like that. And then we'll be charging a percentage, which includes our CFO, which includes the money we make from the discounted invoice. Our goal is always to make it as simple as possible for the founders, so they don't have to think about how exactly does it all work. We just, with everything we do, we give them sort of a high-level summary, like here are the actionable steps, this is what you should be doing, and here are the implications. If you want to understand more, if you want to learn more, then we can dig into it more. Whether that be with how we work with them, whether that be with the recommendations we make, it's the same way.
And as trends evolve, as the GCC market evolves, how does HFS evolve as well with time?
So I'm very proud to say that we've been leading the market in this space for a few years. We are doing two things. One, we're highly anticipatory of what our clients need, and we're able to understand what they're going to need because we're tied into the financial aspects of their business. We're meeting with them every month. We're understanding the challenges they face today. However, a lot of challenges that these businesses face flow on from tight working capital, which is affected by their cash conversion cycle, which is affected by the large corporates. So we're also tied in with the large corporates, seeing what are they going through today, which is going to affect how they treat their suppliers in 3 months, in 6 months, in 9 months from now. So then we know, okay, their suppliers, our clients, they're going to need A, B, and C at that time. So we're both analyzing from internally within our client's business in real time, of course. We're also anticipating based on external data. That's one example. We have a few other channels that we tap into. But this is how we stay not just with the best, but being the best.
That sounds amazing. And, it just makes me feel like HFS has such a bright future ahead. What are the initiatives that you have in mind or you have in place for the future of HFS? Like what's next?
One of the things that we're really focused on is aligning our goals with the goals of the leadership within this emirate and within this country. So we're going to be here the next 10 years, 20 years, 50 years, inshallah. So with that in mind, we want to be aligned. What does that mean? One of the things I love about here is that the leadership is so involved with their initiatives supporting small business. I mentioned before I was involved, of course, with SPC. We have the promotion for all of the companies that are coming from SPC Free Zone. We're also supporting companies along the federal lines as well. So we supported AIM Congress last month, judging all of the startups, the national champions in their competition there, which was run by Ministry of Economy. Also, just last month, we supported the Ministry of Industry and Advanced Technology when they were running the Make It in the Emirates campaign. Now, we were judging and we were involved in the process of awarding grants for all of these amazing businesses. But importantly, we also got to identify businesses that we could potentially fund. And we're now, in a few weeks from now, offering complimentary CFO and advisory to many of the competitors, if I can call them that, for these grants. So we're supporting the businesses that come through those programs because we know these businesses are aligned with the values and the strategic goals at a federal level, as well as the companies that come through great free zones like SPC Free Zone.
What would you say is the single most important piece of advice you would give about managing your cash flow to a new entrepreneur?
I think the most important thing that any founder could do is come work with HFS. We, of course, we're funding these businesses and we handle all of their challenges related to finance with the fractional CFO. Yeah. If for whatever reason, maybe they're B2C or they aren't able to join with HFS and apply, then for these businesses, something that I see again and again and again is overbuilding their capacity. It breaks my heart when I see, and we've all done it as founders, we overspend on things we don't need to, and we expect revenue to come in from large clients that don't end up paying. What do I mean by that? There have been so many examples we've seen of small businesses, amazing founders start these small businesses and they get their big break. They feel like they've hit the jackpot. And this big client that they've got says, we'll just 10 extra revenue with this single job. However, you have to accept later payment terms. And then these big corporate clients don't pay. In scenarios like this, it's crushing for these founders because they've scaled up their expenses. They've scaled up expectations of all of their staff, their suppliers, everything. And when they don't get paid when they've just scaled up, it's really catastrophic. It's heartbreaking to see.
How can such entrepreneurs get relief from a scenario like this where they have taken on more than they can deliver, and even when they do deliver, they don't get paid? What is the relief that an entrepreneur can seek?
So this comes back to their financial planning in the business, whether they have a fractional CFO like us or if they're doing it all themselves. they have to take into consideration what would happen if I don't get paid by this job. Do I have a rainy day fund? We have an expression, putting too many eggs in one basket. If they put too much into one relationship, into one client, there's really nothing they can do about it. If they want to minimize the chances of their client not paying them, so optimizing the chance of getting paid, there are lots of things companies can do. Ensure that their product or service is genuinely important to the client that they're providing it to. Like in the example I gave earlier, which was with the aquariums, super important. Yeah. The other example I gave with the biofuel, the buyer in that example needed that fuel to sell to certain of its customers globally. So these were clients that we funded that they had to get paid by the large corporates. Other things are all around billing procedures. We have an expression, it's like a mantra. The squeaky door gets the oil. So in your home, whichever door it makes the squeak, that's the one that you put the oil on. So that's the one, make a bit of noise, develop a relationship with whoever it is that's paying the invoice. So it's a lot easier for these large corporates to not pay if they fundamentally don't care. But when I say large corporates, it's not corporates clicking a button to pay your invoice. It's a human.
True.
And a lot of these founders, with their business development, they do so much work with, especially with corporates like a procurement division or whatever division it is, which isn't accounts. They do so much work building relationships to get the sale, but they don't put any effort into building relationships with the accounts department or the payables department to ensure that they get paid. So little things depending on the nature of their business. But one thing I did in my previous company was that I was running before I ran this business is I would always, the first time I served a client, I would drop off the invoice in person, say hello to the accounts department, and just make sure I have a point of contact. And we call it putting a face to the name, just humanizing it. Because everyone knows that if you don't pay a bill, there's someone at the other end that's hurting. But if there's a face to that name, it just every little bit helps. So making sure your product or service is important, humanizing the relationship, making sure that you have something about your product or service where if they don't pay you, maybe you can turn it off or you stop providing the service which they need. All of these factors are not dependent on legal contracts, because if you're having to implement a legal contract, that's probably at least 6 months after they haven't delivered. So you've already had a huge hit to your working capital. Then you have upfront costs of starting a legal case. And then you don't even know if it's going to work out because your one-man legal team is going to be much smaller than their powerhouse team with the biggest legal firms in the country. So we encourage companies not to focus on legal avenues. Try and preempt such issues by all of the points I just described.
Yeah, like you truly work in a positive way by building the right relationships rather than doing damage control once things are messed up. And it's such sound advice for businesses to keep in mind before or at the stage of even onboarding the client. Malachi, that brings me unfortunately to the last question of the podcast. It was truly a very enriching session. And I would just want to end this with your views on the future trends that entrepreneurs need to keep in mind going forward with regards to financial services and cash flow management.
I think there's so much to say about where the market's headed. The first thing I would want to address is something we touched on earlier today. The market's going well at the moment, but there will be a contraction of sorts. There always is, inevitably. Companies need to have their rainy day fund set aside in anticipation of when that happens. That would be the single biggest piece of advice, other than, of course, reaching out to us and getting our CFO services and funding. As far as other trends, it's only going to get harder for these businesses to access funding. There's little appetite from traditional lenders, and there's no appetite from VCs for most of these businesses because they're not VCable. Mm-hmm. So what that means is there will be an increase in non-bank financial institutions looking to fill that void. So, of course, we're one solution, and we work with other solutions in the market as well. We find the best solution for our clients. All of the companies that will be funding these micro enterprises, they're looking at what's the quality of your relationship with your clients? How likely are you to get paid? So if you can curate your clients, it's really hard to say and it's even harder to do, but you have to cut the bad clients. Try and focus on having good clients that pay well, that you have long-term relationships with, sustainable, sensible growth. And when you do that, groups like mine and others that enter the market a few years behind us, they are more attracted to funding your business. So that would be something that these founders, any founder can do from today to be ready for a few years down the road.
That brings us to the end of this podcast. Malachi, thank you so much for coming in today and for your invaluable insights. And I'm sure our audience would have got a wealth of information from this podcast today. Thank you so much.
Thank you. I appreciate it. Thanks for having me.